Hello everyone. So today's topic of discussion is current liabilities. Now we have already discussed in previous video what are current assets. I'll leave that link in the description as well as in the I button. The next thing that we need to understand as its parallel is the current liabilities. Now current liabilities of a company are its short-term financial obligations which they have to pay either within 1 year or within one operating cycle, whichever is greater. Now what does that mean? Either their obligations need to be covered within 1 year or one operating cycle. Operating cycle is basically the time it takes to convert its inventory into cash, right? So whichever of that is greater as per the company's overall operational structure, they put their current liabilities into their accounting system according to that, right? Now the next thing that comes to our mind is what are current liabilities, right? So things that are covered under current liabilities are basically account payables. Like in current asset it is account receivables, in current liabilities it is account payables. Basically the short-term obligations, let's say you have to do a payment to a supplier and obviously it has to be done within 1 year, it will be covered under account payable because you have to pay the supplier, right? Then other short-term debts that need to be covered within a year, your tax liabilities that have to be covered, interest payables, short-term interest payables, all of these comes under current liabilities. How are they different from long-term liabilities? The long-term liabilities are the liabilities that are not covered or are not due to be paid within 1 year, and obviously it can take more time, like long-term borrowings, long-term bonds payables, your long-term lease obligations, all these come under long-term liabilities, right? So that 1 year factor or one operating cycle factor is really important. It was also important in current asset, it is also important in current liabilities, because overall current asset and current liability helps you understand the present status of the company, present operating status of the company, how viable it is, how it is performing at the present time, right? Now, current liabilities, it is also important to know that it is derived from current operations, as I just told you, right? Now, what comes under current asset? Obviously, as previously discussed, instead of current payables, you'll have current receivables, right? Account receivables. So whatever you are expecting to come back to you within 1 year, that will come under current asset, because obviously that is part of your assets, right? Your inventory, you have your liquid assets, your direct cash holdings that you have, all these comes under current asset versus current liabilities. Now, there are two important calculations that basically tell how the company is doing in terms of its current working operations. One is the current ratio and other is the working capital. Now current ratio you basically find by dividing the current assets by liabilities, and if that value is greater than 1, that means the company has enough resources to convert its current asset into cash and take care of its short-term liabilities. So obviously greater than 1 is always preferred. Similarly, working capital is basically how much capital the company has to take care of its current operations. Current operations means it can be salaries, it can be bills, it can be short-term obligations they have to pay, short-term taxes. So obviously company needs money to do that, or even to buy inventory. So how much it has and how much it doesn't. So obviously a positive value is really important. So for that, current assets are current liabilities are subtracted from current assets, right? And if that value is positive, obviously a company is doing good. Even for investors, these ratios are really important, because that is how they see the companies is performing in short term. And if the working capital of a company is good, is the company in reinvesting it into further ventures? Is the company paying dividends to its investors? What is it doing? Because having very high working capital is also not good for the company if it is not managed properly. If you have very high working capital, you have high cash flow with yourself, you have high current assets with you, and you're not reusing it, you're not reinvesting it, you're not giving it back to the investors, and it's basically just lying there, then also it is a bad indicator for the company, right? That it is not managing its assets properly. Obviously too low working capital is also bad, but it should never be less than the current liabilities, right? So yes, this is a very short topic, but these current assets and current liabilities are really important to understand in further understanding the operational value of a company, right? I hope this topic was informative, and obviously we'll bring and discuss further in the coming videos. We have a lot of things to discuss. We have a lot of things like liquidity, what are liquid assets, illiquid assets, all those things will be discussed. So yeah, I hope you like the video. Please like, subscribe and share, and please take care of yourself. Thank you.